Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So today I'm going to be telling you a story. It's a story that Warren Buffett wrote about way back in 1963 in one of his letters to investors in the original Buffett partnerships. It's a story that Monish Pabrai has told students in some of his previous lectures. And it includes some mental models which Charlie Munger up here loves to talk about. So I hope you enjoy it. For me, it reinforces some of the core fundamental principles behind long-term investing. So I hope it does the same for you. And for now, let's get into it. Okay, so this is a story about how the native Indians sold the island of Manhattan right back in the 1600s. So I'm going to put up some photos of Manhattan in the video here now, which you should be seeing at the moment. Bear in mind that in the 1600s this was very much undeveloped, and a lot of what you're probably seeing right now wasn't there at the time. But it's an enormous area of land, and it's something that on the surface of things was sold for a very cheap price back in the 1600s. So the island of Manhattan was rumored to have been sold for the large sum of $24. So obviously we've had a lot of inflation since 1626, but nonetheless $24 seems like a pretty minuscule price to pay for the island of Manhattan. So I want to analyze that and get into the sort of opportunity cost of giving up the island of Manhattan versus taking the $24, and trying to tell the story in a way that we can turn that $24, a very, very small amount of money, into a large amount of money over a long period of time. So if we assume that that $24 was accepted by the native Indians when they sold the island of Manhattan, and let's assume that the native Indians had a relatively switched on investment advisor at the helm, and they could invest that $24 at 7% per year. One of the mental models that we can use is compounding and the rule of 72. It's the very first video I put in this channel was how to use the rule of 72, and we can see what that $24 could potentially have turned into by basically today, had that been invested at a reasonable rate of return. So how do we do that? Basically we use the rule of 72 like I said. To make the maths easy, we're going to assume that the native Indians could produce a 7% return per year. Now if we use the rule of 72 and divide 72 by 7, we get approximately 10, which is about the period of time that it should take that money to double should it be invested at a 7% rate of return. So if we use the rule of 72 and we count up the number of doubles that happen, let's say per century in this case, we end up with 10 doubles. So over 100 years, it doubles 10 times. 2 to the power of 10 is 1,024. If we throw away the 24 to make the maths easier, we have basically 1,000x over 100 years if we can invest at a 7% rate of return. So if we go through the maths, we end up with $24 in 1626. In 1726, we end up with $24,000. In 1826, we end up with $24 million. In 1926, we end up with $24 billion. And in 2026, we should be on track for $24 trillion. So we're not quite at 2026 just yet. We're a little less than a double away from 2026. So let's be conservative and cut that in half and say that the native Indians should be having around $12 trillion in wealth built up if they've been able to capture that 7% rate of return. Now $12 trillion is obviously a very substantial amount of money, so that our final step in the story of trying to figure out whether that was a good financial decision or not to sell the island of Manhattan is we need to figure out what the island of Manhattan is now worth. Is that worth 12 trillion or more or less than 12 trillion? Would we have been better off keeping the island of Manhattan and developing it and doing all that sort of stuff? Or would we have been better off basically indexing and getting exposed to equities and that 7% long-term growth like our native Indian investment advisor has theoretically done? So if we look up basically the overall wealth of the entire country of the US, in 2018, that was right around $100 trillion. So I don't know what the island of Manhattan is worth, but I would bet a substantial amount of money, probably 13 trillion if I had it, that the island of Manhattan alone does not represent north of 10% of the total wealth of the US. So when we look at this example, we can see that compounding has worked wonders for the native Indians in terms of growing this money, and it was probably a good financial decision had they invested that money. Unfortunately for the native Indians, they did not have a relatively switched on financial advisor at the helm of their investment operations, and they obviously haven't been able to achieve that. Whether the story is even true, I don't know, but I think it serves as a pretty powerful example for how a very small amount of money can grow into something quite substantial over a long period of time. So let's get into 3 of the sort of mental models that are in behind this story that you can utilize in your own investing to probably not become a trillionaire, but to hopefully grow your wealth substantially from the point at what you started. Okay, so mental model number 1 that you can utilize from this story is clearly the power of compounding. So Einstein's rumored to have said that compounding was the 8th wonder of the world, and it still is. And it can do dramatic things for your wealth creation over time. So with compounding, there's really 3 variables that we can mess with. And these are the 3 variables that you obviously, in a perfect world, would want to maximize as much as humanly possible. So the first one is your level of starting capital. So what are you starting out with today? What are you investing day one in your sort of investment journey? That is going to have a relatively large impact on what you end up with at the end of your investment journey. Now, if you can maximize some of the other variables like the length of compounding and the rate of return you generate and those sorts of things, the level of starting capital is going to become far less important. But being able to have a large amount of money up front is clearly going to allow you to grow that into more money in the future than you would have been able to if you started with 1 cent. Fortunately, if you start with 1 cent and you live for several hundred years, then you might be able to grow that into something quite substantial nonetheless. So that's the first one, is starting capital. The second one is length of runway. Unfortunately, this is something where we're going to be limited. Unlike the Native Indian Investment Trust, we are not going to be investing for several hundred years unless we have substantial changes in medical technology, which I hope for, but I highly doubt. So, unfortunately, we're probably not going to be investing for 400 or 500 years or anything like that. But the point here is to get started as early as possible. So, if you take an extreme example and you look at someone like Warren Buffett, Warren Buffett bought his first stock at the old age of 11. So he got a very, very early start in his compounding journey. And he's still compounding today at, I think, 89 years old. So he's had one of the longest runways of compounding in history. And he's been able to generate great returns and continue to funnel more money into that sort of compounding engine. So he's maximized basically all 3 levers. But nonetheless, the length of that runway has been massively important for him to get to where he is today. He is currently worth about $80 billion. It would be well north of $100 billion if he hadn't donated so much to charity at this point. But he didn't make his first billion until he was past 50 years old. And that's just the nature of compounding. Those later years are very, very important. The gains get larger and larger and larger every single year, as you've got more money that sort of accumulates interest on interest on interest and so on. So that's the second thing. So we've got starting capital, we've got length of runway. The final thing, the third one, is rate of return. So this is one that we do have some element of control over. Certainly not the amount of control to where we can just crank out like 30% a year if we want to. But we do have some control. So you do have a choice of what asset classes you choose to invest in, whether that's stocks, bonds, real estate, Bitcoin, whatever it is. And the data is pretty clear on the fact that the stock market has been the best returning kind of asset class out of all of those over the entire length of time that we've got data for. Real estate is probably the next one in behind there, and then the non-producing assets like gold are way down the list. So There are factors that make that analysis a bit more complex. If you've been using real estate investment as a vehicle and you're also utilizing leverage effectively, that can certainly outperform the stock market and so on. But essentially, your asset class is going to be a very big driver of where you end up in terms of your average rate of return over your investment lifetime. So that's the first one. The other one is there's obviously some element of skill involved. If you are an index investor, you will just get whatever the index returns. If you pick individual stocks, you may do far better than the index, you may do far worse than the index, depending on how you do over time. So those are all things that will affect your rate of return. And if you outperform the stock market by even a couple of % a year, or if you underperform the stock market by even just a couple of % a year, that can have a substantial influence on what you end up with at the end of your compounding journey. Okay, so for me, this story enforced two other mental models. So we have the mental model of compounding. The next one we have is the rule of 72. So not going to talk too much on this because we've already kind of gone through an example of it in the video. But the rule of 72 is very, very powerful. I use it for compounding numbers in my head, which is exactly what it's designed for. And whether that be compounding investment returns, or I often even use it with compounding growth rates of a company. So, for example, if we take someone like Amazon at the moment, and we think that they are going to grow their earnings at a certain rate over the next 10 years, say, we can use the rule of 72 to figure out what that grows their earnings to over that 10-year period, and whether we think that's realistic or not. So if we run some numbers right here, I'm just going to pull some numbers out of the top of my head, which I haven't done before, and we're going to use the rule of 72, so I can just kind of show you how it works. So let's say Amazon earns $1 to make the maths kind of simpler. Let's say they earn $1 in earnings today, and we think that they are going to grow their earnings at 24% a year over the next 10 years. That's something substantial, and we'll see what we end up with at the end and whether we think that's realistic. So if we use the rule of 72, 72 divided by our growth rate of 24 lands us on a time to double of 3. So and from year 1 to 3 years later, we're going to have earnings go from 1 to 2. 3 years later, earnings go from 2 to 4. 3 years later, earnings go from 4 to 8. At this stage, we're 9 years into our 10-year analysis. And if we add a little bit on the end, let's say they're earning $10 a share in 10 years. So that's an example of using the rule of 72. Can speed up that compounding maths quite quickly in your head. It's obviously just an estimate, but it is a very handy sort of mental tool to do that. So if Amazon can grow their earnings at 24% a year over a decade, they're basically 10xing their current earnings. So you can use that kind of maths to figure out whether you think the growth rates that you're assuming in your valuations and your discounted cash flows, all that kind of stuff, are actually realistic and achievable. You know, do you really believe that Amazon can achieve those growth rates? If you do, great. If you don't, well, that's equally great. You've avoided hopefully overpaying for the business and losing money on it, which is actually our final mental model. So like I say, our final mental model is don't lose money. And obviously that's something we want to avoid at all costs. And it's not actually something that either Monish Pabrai or Warren Buffett kind of talked about in their examples of this story, but I think it's a very important one, and it's a nice example to lay out just why it is so important. So I'll put up a screenshot of a quote here from Warren Buffett. Rule number 1, don't lose money. Rule number 2, don't forget rule number 1. And those are kind of the only 2 rules in investing. So Phil Town named his business and series of books and everything off it. So you'll see those as well. And basically the reason for don't lose money is, let's say we had the same story with the Indians investing over their long period of time at 7% a year. Let's say they had some rogue investment manager come in year 1, make some super risky investment, and let's say they lost 50% in year 1 before the more astute investment advisor came in and started cranking out 7% a year for 400 years. So if we had that happen, we'd take that $24 and we'd turn it into 12 if we lost 50% on that investment. And you know, that's bad. We've lost $12. And that doesn't sound particularly life-changing, but if that's all the starting capital you ever have, and you're not contributing regularly to it like they weren't in this example, Then if we now compound that $12 over our 400-year period, we end up with $12 trillion rather than $24 trillion. The opportunity cost of losing that money is $12 trillion. It's a very substantial amount of money. It's 10% of the wealth in the United States. So that to me really enforces the mental model of, at all costs, whatever you do, try to avoid losing money. It's going to happen, unfortunately. We're going to make mistakes as investors, and we can have a pretty high error rate. And fortunately, in the business of investing, we can still do okay over a long period of time. But really, we want to avoid as much as possible losing money. We want to minimize those losses and minimize kind of damaging our compounding engine over time. So the way we do that, of course, in a value investing context is implementing a margin of safety. So never paying full price for a business. Businesses can have turbulence and things that go wrong. So if we can pick it up for substantially less than it's worth, we diminish the chances of losing money, of course. So those are my thoughts. I hope you enjoyed the story, and I hope that reinforces some mental models for you as well. If you did enjoy the video, hit like and hit subscribe. You can watch some older videos over there. Hit subscribe over there if you haven't already, and go the Chiefs. I'll see you in the next one. Cheers.